Today's topic is navigating agency issues, inflation, and taxation in contemporary finance. Namaste. Hello, myself yours. Himalayan Soul with ChatGPT. Gonna explain you today's topics. Let's begin.
Agency problem principal agent relationship. An agent is the person that acts, whereas the principal is the person that receives the benefits from the action. Principal, the person who owns and benefits from the business. Agent, the person who manages or makes decisions on behalf of the principal. Example, shareholders, principal, hire a CEO, agent, to run the company and make business decisions. Problem arises when there is a conflict of interest between the needs of the principal and the needs of the agent. Arises when there is a conflict of interest between the goals of the principal and the agent. The agent may act in their own interest instead of working for the benefit of the principal. Example, a manager might focus on personal bonuses and increase short-term profits, even if it harms the company in the long run. Agency costs, direct agency cost, actual expenses incurred to monitor and control agents. Example, auditor fees, performance bonuses linked to company goals. Indirect agency cost, losses due to agents not acting in the principal's best interest. Example, managers avoiding risky but profitable projects to protect their own job. Factors preventing agency problems. 1. Shareholders' interference. Active involvement of shareholders keeps managers accountable. Example, voting rights in board meetings. 2. Threat of dismissal. Managers can be removed if they act against company interests. Example, CEO fired for poor performance. 3. Hostile takeover. If management fails, outsiders can take over the company, pressurizing managers to act in shareholders' interest. Example, a bigger firm acquiring a poorly managed company. Inflation and financial management. Inflation, it is the sustained increase in the average price level of an economy. Easy explanation. Inflation means prices of goods and services keep rising over time, reducing the purchasing power of money. Example, if milk costs 50 rupees today, it might cost 55 rupees next year due to inflation. Areas affected by inflation: financing decision, investment decision, working capital decision, dividend decision. Easy explanation. Inflation affects all business money decisions. Financing. Borrowing becomes costlier. Investment. Future returns may reduce. Working capital. Operating costs increase. Dividends. Firms may reduce dividends to save funds. Example, a company may delay new investments due to rising costs during inflation. Impact of taxation on financial management. Impact on profits. Effect of taxation dividends. Tax on dividends is a cash outflow for business. Cost of capital debt reduces tax because interest is tax deductible. Cash inflows. Depreciation reduces taxable income, increasing cash flow. Set-off losses. Company can adjust current profits against past losses to reduce tax. Unabsorbed depreciation can be carried forward and adjusted with future profits. Amalgamation losses can be carried forward during mergers to save tax. Tax incentives. Help decide business structure, industry type, size, and location. Example, a company using loans pays less tax due to interest deduction, reducing overall cost. The role of finance functions in the contemporary scenario. Finance function in contemporary scenario 1. Managing the financial resources of an organization. Explanation, ensuring there is enough money for operations, investments, and growth. Example, a company managing its working capital to pay salaries, buy raw materials, and pay bills. 2. Ensuring financial resources are used efficiently and effectively. Explanation, using money in a way that gives maximum benefit with minimum wastage. Example, a firm investing in energy-saving machinery to reduce electricity costs. 3. Providing financial information and guidance to support decision-making. Explanation, supplying data that helps managers make informed choices. Example, The finance team preparing a report on cost-benefit analysis before launching a new product. 4. Managing relationships with financial institutions, investors, and stakeholders. Explanation: building trust and communication with banks, investors, and others. Example: a CFO negotiating better loan terms with a bank or presenting company performance to shareholders. 5. Overseeing financial reporting. Explanation: making sure financial statements are accurate and comply with laws. Example: preparing the company's annual report for submission to SEBI in India. 6. Assessing and managing financial risks. Explanation: identifying potential financial threats and creating plans to handle them. Example: a company using hedging to protect against foreign exchange fluctuations. 7. Developing and implementing financial strategies and plans. Explanation: creating financial goals and the steps to achieve them. Example: a 5-year plan to reduce debt and increase revenue by expanding into new markets. 8. Providing leadership and direction for the finance team. Explanation: guiding and managing finance department employees. Example: a finance manager mentoring junior analysts and setting monthly targets. Summary: finance functions today include managing money, using it efficiently, supporting decisions, handling risks, and maintaining good investor relations. The agency problem happens when managers, agents, don't act in the owner's, principal's, best interest, causing losses. Inflation raises costs and affects all money decisions. Taxation impacts profits, cash flow, and investment choices. Good financial planning and control help businesses grow and stay strong. That's all for today. Thank you. See you in next video.